Hi. Let's learn about house calls. A house call is made by a brokerage firm when an account holder doesn't have enough cash to cover a shortfall in the margin account. This shortfall usually occurs after losses in investments that were bought on margin. If the account balance falls below the maintenance margin required by the brokerage firm, the house call is issued. If the shortfall isn't made up in the specified time, the account holder's positions will be liquidated. A house call is a type of margin call, which is made when investors buy assets on margin using borrowed money and fail to retain a minimum amount of cash or securities to offset potential losses. Buying on margin allows investors to potentially multiply their returns, but also increases the risk. If the value of the investment falls below the required deposit, the investor can cover the shortfall by depositing more cash or selling other assets. House calls usually come with a specified period within which the margin maintenance requirement must be met. The maintenance margin is the minimum equity an investor must hold in the margin account after the purchase has been made. The investor's equity must not fall below 25% of the current market value of the securities in the account. If this requirement is not met, the brokerage firm may liquidate the securities in the customer's account. If the price of the shares falls, the investor needs to repay the borrowed amount to the brokerage firm. If they owe more than they have deposited in reserve, they must make up the difference to the house. Here are 3 key takeaways. 1. A house call is a brokerage house demand to restore the minimum required deposit in order to offset losses in assets bought on margin. 2. Buyers on margin borrow from the brokerage to potentially increase their gains. 3. If the investment's value decreases, the buyer owes the brokerage firm. Hope this would help. Thanks for watching.